The Fed just cut rates, and people are asking what this means for their financial strategy. Here's why your simple system works better than reactive decisions. Welcome to Simple Finance Bites. I'm Ernest, and this podcast is my letter to my younger self about money, the practical strategies I wish someone had taught me when I was starting out. We focus on simple finance because simple is what actually works. Your brain can handle simple systems, but your brain struggles with complex ones. The financial industry profits from complexity, but we're going in the opposite direction. We're using simple strategies that work with how you actually think and behave. Before we jump in, if these episodes are helping you, the best way to support the show is by subscribing and leaving us a review on Apple Podcasts, Spotify, YouTube podcasts, or wherever you listen. Then, share it with someone who needs to hear this content. It really does make a difference. Also, connect with us on social media. We're on Instagram, Threads, and Facebook for now. We will be expanding to some other platforms down the road. All the links are in the podcast description, show notes, and on our website at simplefinancebites.com. If you want to stay connected with our simple finance approach, make sure you're signed up for our free newsletter at simplefinancebites.com. Each month, I share exclusive simple finance tips that don't make it into the podcast. Plus, I call out financial industry tactics that keep people confused. Today, we're talking about something that just happened. The Fed announced a rate cut in September, last week as a matter of fact. What does this mean for people following the simple finance system? Should you change your strategy? Should you panic? Should you celebrate? Here's the simple finance perspective on staying on course when rates change. The Federal Reserve cut interest rates, and it's natural for people to wonder if this changes their financial strategy. Here's the simple finance truth. When rates change, most people make the same mistake. They overreact. This happens because our brains give too much weight to recent events, something called recency bias. When rates change, your brain thinks, this changes everything, when the reality is usually much more nuanced. The financial media amplifies this because dramatic change drives clicks and views. Breaking! Fed cuts rates. What this means for your money sounds a lot more compelling than Fed cuts rates. Your long-term strategy probably doesn't need to change. But here's the truth. If you're following a simple finance system like ours, rate changes are minor course corrections, not major strategy overhauls. Your brain wants to make this more complicated than it needs to be. But simple finance shows us a better way. Now, I've lived through multiple rate changes throughout my life. I was around when the rates were almost zero after the 2008 financial collapse. I was alive, but not really in the finance space when the interest rates were super high in the 80s. It doesn't matter. It's all going to pan out to be the same. You have to remember that the rate changes, while they affect several things, for people on the simple finance system, there's only two areas that it affects. One of them is your emergency fund, and the other one is potentially buying a house, and we'll talk about that later. If this resonates with you, but you're struggling to implement it, I do work with people one-on-one to build these systems. SimpleFinanceBites.com has details. Now, the industry profits from your reaction to rate changes because reactive decisions usually benefit them more than you. So, let's talk about what actually changes when rates get cut, and more importantly, what doesn't change if you're following the simple finance system. What changes? Your high-yield savings account and money market rates will probably drop over the next few months. New mortgage rates might be slightly lower, though they don't always move in lockstep with the Fed rates. Some bond prices might rise. Some dividend stocks might become less attractive relative to growth stocks. What doesn't change? The fundamental logic of the simple finance system. You still need an emergency fund and a liquid account. You still need to invest consistently for the long term. You still need to optimize your expenses, and you still need basic financial protection. Here's a key insight. Simple systems are not fragile. They get stronger from stressors like rate changes because they're built to handle variability, not to optimize for specific rate environments. Complicated strategies that try to time rate changes, those are fragile. They work great in specific conditions, but they break when conditions change. And here's something important about rate changes and spending. Don't let lower interest rates trick you into financing purchases you couldn't afford before. I'm not saying not to buy anything. I'm saying you can buy whatever you want as long as you can afford to buy it cash outright. Even if rates drop, debt is still hanging over your head. This is one that I'm very concerned about because, as you know, the housing market has been a little bit locked up lately. Housing prices are generally unaffordable in just about any major city in the United States. People are trying to buy homes, but they can't. The interest rates are holding them back. And I'm very concerned that if the interest rates drop just a little, it might trick people into jumping into a major investment like a house without thinking it through first. Don't do that. Always think through your financial decisions. Always run the numbers. Building wealth while maintaining rate changes can be tricky. So if you want personalized help, check out my one-on-one coaching at simplefinancebites.com. The simple finance principle here is that consistency beats optimization over time. Your brain wants to optimize for current conditions, but wealth building happens over decades, not quarters. So, here's how people following the simple finance system should think about rate changes. Minor adjustments within your existing framework, not dramatic overhauls. Let me repeat that. Minor adjustments, not dramatic overhauls. So, let's hit the key areas as we go through here. For your emergency fund, keep it in your high-yield savings account or money market account. Yes, the rate might drop from 4.5 to 4.0% or whatever. Maybe it's going from 3.8 to 3.5. Who knows? But the purpose of this money isn't maximum returns. That's what your investments are for. The purpose of your emergency fund is liquidity and peace of mind. Don't chase rates by moving money around constantly. That's complexity that doesn't add meaningful value. This is one that I really have to harp on here. Just because one bank is paying 4.0% interest on a high yield savings account and your bank is paying 3.85, don't move your money just to get that 0.15%. That's complexity that doesn't add meaningful value. As long as your bank is paying a competitive rate, basically anything above 3%, you're fine. Don't move it. Again, it's about liquidity and peace of mind. This is not your investments. Speaking about investing, here's where your investing comes into play now that the rate cuts are happening. Keep investing consistently. Rate cuts often happen because the Fed is trying to stimulate economic growth. Sometimes this helps stock returns, sometimes it doesn't. Your job isn't to predict which way it'll go. Your job is to keep investing regardless. Right now is a very volatile time in our economy. We have no idea how this is going to pan out. The Fed is trying to react to essentially the job market collapsing on itself. So be careful. Do not change your plan. Keep investing consistently. Always keep your eye on the ball and keep looking down the road. For housing decisions, if you've been following the simple finance system and were already in a position to buy a house, you have your emergency fund, you're investing consistently, you're living the prepaid lifestyle, then slightly lower mortgage rates might make the timing a bit better. But don't buy a house just because the rates dropped if you weren't ready before. The prepaid lifestyle means you're financially prepared for major purchases, not reacting to rate movements. This is another one that I've seen people make a mistake on. They're so anxious and so just wound up about buying a house. They will want to do it at any cost, and it doesn't matter what the fallout is. And it doesn't help that on social media you have so many people pushing real estate investing, or you must own a home or else you're throwing money away. All of that is false news. All of that is fake news. You buy a house when you are ready to buy a house, not before and not after. The key is that rate changes inform your decisions within your existing system, within the simple finance system. They don't blow up your system and require you to start over. Let me rephrase that. When the rate changes happen, you need to look at them from the perspective of, how does this affect my current system? You don't want to come at it from the angle of, I need to blow everything up and start over and completely redo my system. If you're looking at it from that angle, you have the wrong system. So remember, it informs your decisions within your existing system. And if you're listening to this podcast, that's the simple finance system. Here's what I want you to understand about simple finance systems and rate changes. They're designed to work across multiple rate environments, not to optimize for any specific one. Otherwise, we have to change every time they change the rates, and we don't want to do that. We want a simple system that we can just set it and forget it. So I want you to think about this. Over the past 50 years, we've had Fed funds rates as high as 20% in the early 1980s. Think about that for a second, 20%. So imagine what mortgages were at. But we've also had it as low as near zero after the 2008 financial collapse. People who built simple, consistent financial habits, spending less than they earned, investing regularly, maintaining emergency funds, did well across all these different rate environments. People who tried to time rate changes and constantly adjust their strategies often did worse because they were always reacting to the last change instead of building for the long term. And especially after 2008, this really caught a lot of people because they lowered the interest rate to almost zero. And as a result of that, it was almost like free money was being printed everywhere. And no one thought, maybe in 2015, 2016 or so, hey, you know what? This is behind us. Let's start raising the interest rates gradually to get us back to a balanced era. They left it too low for too long. And then when they finally reacted to it, shortly thereafter, COVID hit and they had to drop it again. And it just created this entire vortex of problems. And we're paying for that to this day. So the advantage of simple systems is that they reduce decision fatigue during uncertain times. And believe me, we are in uncertain times right now. When rates change and everyone's panicking or celebrating, you have a clear framework for thinking through what it means for you. Instead of, oh no, rates changed, what should I do? It's, rates changed. How does this fit into my existing system? That's a much less stressful way to live, and it keeps you focused on what actually builds wealth. This is something that I've had to deal with again many times over my life, investing or otherwise, is looking at how the rates are impacting everything. And it's one of the reasons I designed the simple finance system the way I did, because I didn't want to have to worry or think about what happens if the rates go up 0.5% or they go down 0.25%. That shouldn't matter in the long term. That is a short-term thing that really only affects debt and borrowing. And in our system, we typically avoid any kind of debt except for a mortgage. So really the only place where this really plays into our picture here is with mortgages. And we've kind of already talked about that. Now, if you want help putting all these pieces together for your specific situation, that's exactly what my one-on-one coaching covers. I can sit down with you. We can look at all of your finances and say, okay, is this going to affect you? Does it matter? Do you have the right stuff in place to get through this? And again, if you're following the simple finance system, you're already okay. This is really for if you're unsure or if you're just getting started and you're trying to figure out what you need to do to adopt this system into your life. The goal isn't to have the perfect response to every rate change. The goal is to have a system that's robust enough to handle rate changes without requiring you to become an economics expert. So let me give you the key takeaway from today. When interest rates change, your simple financial system might need minor adjustments, but it doesn't need a complete overhaul. For most of us on the simple finance system, this Fed adjustment will do nothing. We don't need to adjust anything. It's a tiny blip on a radar. But for those looking towards buying a house soon, and they're already aligned and ready to do it, there might be a little bit of tweaking because interest rates might come down just a hair. If it was me, I would wait a little bit longer for them to come down a little bit more. But then again, when interest rates come down far enough, the housing market heats up again and the prices start going up. So it's kind of a balancing act. Buying a home is one of those very emotional and personal decisions for everybody. And you have to be very careful with it because financial decisions should never be emotional. You should never let emotion drive a financial decision. However, buying a home is often a very emotional decision. So the two are kind of at odds with each other. So you always want to think through that. Make sure you're making the right financial decision. Make sure you run all the numbers. You understand the TCO, the total cost of ownership of buying that house, and that you're ready for it before you do it. Once you're ready, go for it. I have nothing against that. Now, the Fed cut rates this month. Your high yield savings might earn a bit less. Mortgage rates might be slightly lower. But again, if you were following the Simple Finance system before this announcement, you should keep following it after because nothing's changing for us. Remember, simple systems beat complex optimization over time. Consistency beats timing. Your brain wants to react to every rate change, but your wealth building progress depends on staying the course with minor adjustments. Thanks for hanging out with me today on Simple Finance Bites. And a quick note, this is all financial education, not financial advice. So please see the full disclaimer in the show notes before making any financial decisions. If this episode was helpful, subscribe and leave us a review on Apple Podcasts, Spotify, YouTube podcasts, or wherever you listen. Then share it with someone who needs to hear this content. For more insights on simple finance and building real wealth, head to simplefinancebites.com. And if you want the deeper insights behind these episodes, plus your free Simple Finance System Blueprint, join our monthly newsletter. It goes out on the first of every month. Connect with us on Instagram, Threads, and Facebook. All the links are in the show notes. Again, we are going to expand to more platforms in the future. We're a very small team working on this, so we don't have, the time to work on all these, but we will down the road. And again, if you found yourself thinking, I know what to do, but I just need help implementing it, I work with people one-on-one to make that happen. The details are on simplefinancebites.com. Before we wrap up, a quick security reminder that applies to everything we've discussed today. Enable two-factor authentication on your email and banking accounts right now. It's the simplest way to protect the financial progress you're making. Your future self will thank you for this 5-minute investment in security. Until next time, keep it simple, stay focused, and take control of your financial future.